Closing costs are actually additional cost on top of the down payment when you purchase a home. Many buyers think that the closing costs and the down payment are the same thing, or they both combine into one, what we call package. It's actually not. Closing costs are separate, down payment is separate. In this video, I'm going to take you through an example of an FHA loan and fully explain to you what the breakdown is on closing costs, and they can add up. Closing costs are typically anywhere from 2 to 4% of your purchase price. Let me explain. One thing you have to keep in mind is that closing cost varies from state to state, lender to lender, buyer to buyer. So it all changes, but this is a general estimate and explanation of what the costs are and how much you will incur. Of course, I'm not a lender, but if you are looking to purchase, talk to your lender for any specific details. Now, getting back to it, like I mentioned, closing costs range from 2 to 4%. Now, keep in mind that if your closing cost is 2% or 4%, it can add up. On a $400,000 house, if your closing cost is 2%, it comes out at $8,000 on top of your down payment. Stick around. At the end of this video, I have 2 bonus points where I can show you how we can reduce that closing cost. Let's go. Have a pen and paper ready because you may want to take some notes. So the first portion of the closing cost is your loan fees because you're going to get a loan. And we're going to take an example of an FHA loan, and we're going to assume that the house you're purchasing is $400,000. You're going to put 3.5% down. The interest rate being charged is 6%, although that's kind of low right now. There's nothing out there. And it's a fixed year loan. So on a $400,000 house, if you put 3.5% down, your loan amount will be $386,000. So let's take a breakdown of the loan fees. Let's start with the origination fee, or what we call the lender fees or commissions that lenders charge you. And if we take 1 point of fees that they charge on a $386,000, your points they're going to charge you is $3,867. They have a processing fee, which is $350. On each loan, each lender is different. They charge you different fees. But in this example, which I have printed out for California, it shows $350. This is for doing all the paperwork, processing, checking your verification, checking your credit, all that. There's a tax service contract fee, which is $85. There's also a document preparation fee, which is $350. I just had my buyer sign some doc fees, or what we call loan docs, and it was this thick. There's a lot of documents to sign. So in preparation of all those original documents, having everything filled out, everything proper and legal, they charge you the fees. There's also what we call underwriting fees, which comes out in this case at $425. These are again processing underwriting fees that lenders charge. Whenever you get a house, the lenders, most lenders want an appraisal done. So you have to do an appraisal. And in this case, the charge is $475. Of course, different appraisal companies charge you different, but we are using an estimated of $475. There's also credit report fees. Each lenders want to check your credit, the current credit. You can't give them 90 days or 60 days credit. They want to check it on their own. And in this case, it's $60. There's also a flood certificate fee of $25. Lenders want flood certification. Is the area in a flood zone, or if there's floods, they need a certification. So it's $25 for an amount of $400,000 home purchase. Then there is an endorsement fee. This is an endorsement fee when your lender sells it to an investor. There's some fees involved in there, and that's being passed on to the buyers, which is you in this case. And of course, there's notary signing fee. In California, where I'm from, Anaheim Hills, Orange County, my clients just signed loan docs, and the notary was $250 because the notary actually goes to their house and have them sign it at their house. So in this case, we are using $200. And then we have new loan services. That's a fee, that's another charge of $350. So as you can see, these fees add up. And of course, depending on your lender, we always recommend, as realtors, we recommend to the buyers that you talk to 2 or 3 different lenders and get the cost up front. Ask them for an estimate. Hey, if I buy a house at this amount, what are the fees? They'll give you a breakdown. So don't just look at the interest rate, because somebody may charge you a lower interest rate, but charging you very high fees. So what you want to compare when you get a loan, not only the interest rate, but all the closing costs of and the fees that they charge. So that's something you always want to do, and we highly recommend it. The other thing you have to keep in mind, at least in California, the lenders, when you apply for a loan or when you open escrow, the lenders are supposed to give you a GFE, which is a good faith estimate. So when you apply for a loan or when you're processing a loan, they'll give you a good faith estimate, which is all the breakdown. So what the lenders cannot do is at the end of the escrow, 2 or 3 days before, they have to give you another GFE or a closing disclosure. So they cannot change all the numbers in there. It has to match your estimate. Of course, they won't be exact, but if they vary a little bit, it's okay. But if there's a drastic fee, now they're charging you $5,000 origination fee instead of $3,800, that's drastic. Something you want to see all the time is your closing disclosure before you start and just before you close. So that's why we recommend you talk to 3 different lenders. If you need a referral for lenders, feel free to contact me. While you're on this channel and taking notes, we highly recommend that you subscribe to my channel because I post videos like this every week. And also, if you have any questions or comments, please share and write them below so I can answer them and other viewers like yourself can read and share their questions and answers. The next category of fees when you're purchasing a home is what we call the title insurance. There is the owner's title policy. In this case, the charge is $1,521, where the owner or the buyer buys an insurance policy for title, and there's a lender's title policy where the lenders require for you to buy a title policy, and that amount is $855 based on our home purchase in this case. So the title policy, the reason they want a title policy is that when you purchase the home or after you transfer title and after 1 or 2 years, something may pop up where the title company did not do a search and there was a lien in there that nobody saw about, or a past due bill tied on to this property like a mechanic's lien or some other fees. As an example, let's say there was a death in the family and the house was given to 4 siblings, and out of the 4, 3 signed all the documents, 1 had not signed it, and he comes out and sues for his portion of the amount. So those things pop up. Usually they don't, but you never know. So that's why you need title insurance, because you want to protect yourself from past due liens on the property, and also the lenders want to be protected themselves. So in this case, that's the total amount it comes out on this purchase price. Basically, it's an insurance for any title defects that may pop up. The next fee is what we call the escrow fee. At least in California, we use an escrow company, which is a third party where the money goes into there and they handle all the paperwork for the buyers and the seller and any third party like the lenders and the termite company and the repair companies. So the escrow settlement fee in this case is $1,200, and they have additional fees like sub-escrow fees, and that's $125. And I know in some states, at least in the East Coast, I'm in Orange County, California, and I'm Hills, so we use escrow companies. In the East Coast, a lot of you buyers like yourself use attorneys and other professionals, but I'm sure the cost will be pretty similar, or it'll be a percentage of the purchase price. Let's move on to the next category. Yes, there's a lot of categories. The next category is the prepaid cost. What are prepaid costs? These are costs that you have to pay up front. So before you close your escrow or settle your escrow or closing, you have to pay a certain fees before we close. And one of those fees is the taxes. In this example, the property tax is being paid is showing 2 months of taxes to be paid. So on a $400,000 purchase, and in Orange County, our property tax is 1.1%. So the 2 months prepaid comes out at $733.33. Also, when you get a loan from the lenders, they require that you get home insurance or fire insurance, and they want you to pay 15 months ahead. So if you take 15 months of insurance, and this is estimated cost, that prepaid amount of insurance is $2,000. So lenders want you to pay in advance in case something happens, if there's a fire or if there's insurance, floods, whatever. They want to be protected and they want you to have it paid ahead of time. The other prepaid is the lenders. When you close escrow, there will be a charge of 30 days interest up front. Of course, usually you don't pay your payment till next month, but before you close escrow, you have to pay 30 days of interest. And in this case, in our example, at 6% on $386,000 loan amount, it comes out at $1,963.78. So your total prepaid cost in this example comes out at $4,697.11. They all add up little by little. I can't wait to see what the total is. I hope I'm not shocked by the total amount. So let's add these categories up and see what our total is in closing cost. We have the loan fees, we have the title fees, we have the escrow fees, we have the prepaids. So if we add them all up, it comes out to fixed cost of $10,706. Then we have the prepaid cost of $4697.11, which gives you a total of $15,403.11. Wow, that's a lot. It is a lot. Now, to add to this cost, we have to figure out what our down payment was. So our down payment percentage we were going to put down on FHA loan was 3.5% of $400,000. So the down payment comes out at $14,000. So if we add up $14,000 to our closing cost of $15,411, the total cost to purchase this home will cost you $29,403.11. I mentioned to you earlier about bonus points and for you to wait. So if you waited, this is a great tip for you to know. Now the total cost to purchase this home is $29,400. You may say, hey, I don't have $29,000. I only have $20,000 or $15,000 or $25,000. Two things you could do is that you could ask the seller to pay for your closing cost. And this is why if you work with a top realtor who knows what they're doing, who've sold FHA loans. By the way, I have a connection with all the agents who work FHA home purchases and home loans. I have contact with them. So if you're looking for some, contact me and I will refer you to somebody who can work in your area. Going back to the bonus, the one way to do is negotiate with your realtor and the seller to see if they can pay for your closing cost. So in closing cost, it was $14,000. So let's say you're short $10,000. You may ask the seller, hey, can you pay for my closing cost? And this is allowed by the lenders, or make sure you use a lender who allows you to pay closing cost from the seller. So now if your total cost is $29,000 and if the seller gives you a credit of $10,000, you only need to come up with $19,000 from your pocket and not the $29,000. But what happens, here's the second bonus point, and thanks for sticking around. So the second way you can do it is the seller does not pay any closing costs because the market is very hot right now and he has other buyers that's going to pay the full price. The other thing you could do is you could take, let's say you only have the down payment of $14,000 for this example and you short $15,000. Then what you could do is you can take the original price of $400,000. It's going to cost you $15,000. So you can make the price of $415,000 and then ask the seller to pay the $15,000 in credit. So to the seller, you're still paying $400,000. So that can be done as well. Just make sure that when you do that, you're gonna pay additional fees on the extra $15,000 because everything is a percentage. So your loan amount goes up a little bit, your escrow fees goes up a little bit, your title fees goes up a little bit, but it's not significant, it's very minuscule. So if you can do that, that's a good way to do it. And I've seen that happen a lot of times. I've done that myself where I've negotiated from the seller to cut the price or give credit, or we've increased the price and asked for the credit that way. So that's a good way to do it. Before I give you the last tip, I want you to see, if you want to watch this video, it talks about should you buy now or are the home prices going to skyrocket? So check this video out. And the last tip is you may feel that's a lot of money for you to buy a house. And if you're not ready to buy a house, if you don't have the $10,000 or the $20,000 or $30,000 amount of savings that you've had, or if you're not able to borrow it from your parents or your siblings or your friends, then one thing you could start doing is set a deadline on where you want to buy or when you want to buy. Let's say in 2 years, start saving a little bit every month. Start saving, and not only start saving, but start cutting your expense. So one, you're saving, one, you're cutting expense. So in 2 or 3 years, you'll have a lot of payments in your bank, which you can use not only for your down payment, but for your closing cost. Good luck on your journey to become a homeowner.